Welcome to the Let's Talk Property with MFS podcast. MFS are a bridging loan and buy-to-let mortgage provider and not a financial advisors. The opinions expressed in this episode are personal to the host and guest and may not reflect the views of MFS. Hello and welcome to another episode of Let's Talk Property with MFS, the podcast that covers all things property. And today we have the amazing Emma-Leigh from our underwriting team at MFS to talk about all things underwriting today. So hi Emma-Leigh, thanks for coming on board today and joining us.
Hi, thank you, pleasure being here.
Yeah, so I thought maybe kick off and just sort of talk about how you got into the underwriting, your career progress, how you become an underwriter and obviously then eventually become a senior underwriter. So where did it all start for you?
Yeah, so I started in the financial services when I was 18. I had done an apprenticeship in a mortgage broker, just started doing mortgage administration.
Okay.
And I was also learning, it was CMAP, but the government funded version. Due to my circumstances, I couldn't actually finish that. So I managed to get a job in a bridging company as a mortgage administrator, worked my way through the ranks, managed to get mandated there as an underwriter in 2020.
Amazing.
And then moved on to MFS in my senior role now, where, yeah, I'm obviously loving it. And there's more complex cases and more things to learn always.
Kept very busy.
Exactly. Even in this current market.
Yeah, I know. We're still seeing a lot of business despite what's going on. And obviously a lot of people know what an underwriter's role is and have some sort of idea. Some people aren't 100% sure of it. So give us a little bit of an explanation on what an underwriter's role is and the sort of tasks that you have to do to underwrite cases that you receive on your desk.
Yeah, so I mean, the main thing is obviously to make sure that the borrower's requirements and the loan purpose make sense and it's going to have an economic benefit for them. And also to make sure that we're protecting the company and any lending decisions that we have. So the involvement with that would be looking at the borrower's profile, their assets, liabilities in the background, to see what their background wealth is like. Looking at the property to make sure that it's habitable, mortgageable, and there's no issues there. And then it will be looking at their credit profile, looking at the exit strategy. That's probably one of the main things.
Especially now.
Exactly. We want to make sure that obviously they're going to get out of that loan, redeem, and make sure that it's as easy and smooth as possible for them. So, yeah, it's loads of different moving parts that we have to deal with, especially with the clients that we have. Usually they're portfolio landlords and high net worth. So
lots of moving parts.
100%. And you're then looking into source wealth, source funds, that sort of thing to make sure everything's sound. And then you'll move on to the legal process to make sure solicitors are happy with everything.
So obviously we had touched on slightly how you got into the industry. You know, how long did it take you to sort of go through the ranks, and were there any certain qualifications or stuff that you had to sit and exams and everything else to become an underwriter? So
for myself, I didn't have any qualifications. I obviously started my apprenticeship and was learning, I think it was RO1 and RO2, which are parts of CMAP. But I've started in 2016 as mortgage administrator in the bridging company, was with them for 5 years. And by the time I left, I'd been underwriting my own cases under a mandate for a year. So for me, it wasn't necessary, but I do know a lot of people that like to obviously either have CMAP or other financial exams that kind of help them with the industry as a whole. So they understand all the different types of finance things that people might need to be repaying, or if an exit's coming through a pension drawdown, for instance, how that works. So it can have an influence, but it's not necessary. Okay.
Well, obviously at MFS, we're known for complex cases, and I think we're seeing a lot more of them than we would do previously. I mean, specialist clients that wouldn't normally turn to specialist finance, and now turning to specialist finance as an option. Are you seeing the complexity of the cases more complex cases coming through the doorstep as opposed to the vanilla stuff?
Yeah, I think with being a specialist lender, a lot of the things we deal with anyway is complex. But I think obviously since COVID and obviously like the current market at the moment, there are a lot more clients that are looking for finance where they might have adverse that needs to be looked at, or trying to get a development done or a property that they agreed to purchase a few years back, and now it's becoming more complex because of the interest rates and they can't go to the lenders that they initially thought they might have been able to. A lot of lenders are pulling products, so they're not able to use them. So yeah, there's definitely a lot more coming through the door that's not as straightforward.
Yeah, I think especially on the sort of the bridging side of things, I think the ASTL latest figures showed that there was growing bridging completions up to 1.5 billion. So we're seeing a lot more of that. Would you say, there's an increase on, is it something you're seeing a lot more with the underwriting side, that we're getting a lot more inquiries on the bridging aspect?
Yeah, I think because of the current market, a lot of people aren't wanting to agree to like a 2 or 3 year term. Some people obviously think the rates might go down, so locking into their rates where they're quite high at the moment, they're thinking, oh, okay, I might be better off taking a 12 to 18 month bridge where there's no ERCs, and should then the rates start to come down, they might be able to exit onto something that's a little bit cheaper. So definitely things that are coming over on the buy to let, people might then push it onto the bridging and say, we'll take that gamble instead.
Yeah, to be fair, I've had quite a lot of my cases are sort of similar to that as well at the moment, where they're going to buy to let, and people, like you said, they think everything's going to go down, so why am I going to tie myself in at a high fixed rate for 2, 3, 5 years? But I think a lot of people would rather just take that bridge in the hope that things are going to change in the next 12 months, and then they can sort of quickly exit. And then I think as well, with a lot of people using bridging for different purposes. You've seen a lot of people using it, things like title splitting, extending leases on properties, trying to refurb our mortgageable properties to then fit onto our buy-to-let products. What sort of stage, would we look at removing it from a bridge to a buy-to-let? What would you need to see from that?
So I think it depends obviously on the reasons why it's gone into the bridge, but I've seen a lot of things at the moment where on the buy-to-let, and a lot of lenders, not just ourselves, they don't want too much work being done whilst it's on that product. So normally we would suggest going in, getting the bridging loan, doing the works if it's a 3 to 6 month type of refurb, and then once they've done all of that side of things, we'll then look at putting it on to the buy-to-let. But obviously at the moment it's difficult because when you're looking at your ICRs and your stress testing, what they're taking out on the bridging might not always be able to convert back over onto the buy-to-let where you've got that stress test there. So it is a bit difficult when you've got properties that are already highly leveraged.
And I suppose we see quite a lot of that, especially with the portfolio landlords. But I suppose the advantage of us is we don't stress test the background portfolio. Just do a dry loan, so to say. But yeah, I mean, I'm personally seeing a lot more bridging than I am buy to let at the moment for that exact reason. Especially a lot of people buying stuff below market value at the minute. You buy it on a bridge, do a bit of work, wait for 6 months, and then refinance out at market value, giving you a bit of a better chance where you're going slightly lower LTV. Especially with the stress testing and everything else that's sort of going on at the minute. I mean, I guess a common question that lenders and brokers are asking is how quick can the loan process go? Generally, what's the normal hold up when we're underwriting a deal, when we're trying to get it through to completion? What would you say is sort of the fastest and which is the slowest part of that process for you at the minute?
So I mean, it is difficult trying to get things through at the moment. I think solicitors usually tend to drag their heels a bit. With us, we try to keep our buy-to-let and bridging legal side the exact same. So we don't ask for as much as maybe what some other lenders might ask for. We can usually turn cases around, whether it be bridging or buy-to-let, within a couple of weeks, as long as you've got the valuer's availability there and solicitors on board. I would say that I see a lot of it on purchase transactions where they're waiting for searches to come back. And without having those searches, obviously, it's difficult with a purchase to seek maybe search validation indemnity and things like that because it's a new property. Whereas on the refinance side, you can usually try and be flexible and take views. If you've got searches that might have been from when they purchased it 6 months ago, you can take a look at those and then indemnify. So I would just say to make sure that you've got everything already going on with the solicitors in the background so that it's then just dealing with the inquiries at hand as opposed to the things that take a while to come back.
But I think, do you find you have to be a bit more flexible when you're looking at cases now than previously?
Definitely. I think obviously time can be against you at the moment with the rates being amended it seems 6 weeks, I think. Pretty much. So it can be, if a developer says, oh, we're going to complete in July, and then they push it back to August, that can be another 0.5% to the client, which then is going to affect their loan amount again. So where we can take views, we obviously will. We try to be as flexible as we can.
I think flexibility is key in the current market at the moment because obviously things are changing daily. Products are being pulled by other lenders. So where do you see things going over the next sort of 6 to 12 months? When do you sort of think things may change for the better?
I think it's a difficult one. Obviously, if you look at the SONIA and the way that that's going, it's saying even into 2025 that rates are still going to be similar to where they are.
Yeah.
But that is obviously just an estimate. It's not set in stone. But I do think that not any time this year things are going to start going down. I think it's going to carry on going up a little bit.
Last one was a big one, but I think the unfortunate thing is you've still got a huge amount of people that have no mortgages, so they're still spending as normal. You've still got a load of people which are on 5-year fixed mortgages that they fixed a couple of years ago, so sitting pretty, and I think that's sort of the issue, that we're having at the moment. Quite a large people aren't affected by this as of yet and still spending. Obviously the ones that are seeing their mortgages triple, I know some people at the moment which are currently putting their homes on the market because it's just
it's too expensive with the cost of everything else going up as well. I mean, you've got your gas and electricity, you've got even like your TV, your broadband, everything's obviously going through the roof, like price of food, just anything is expensive. And I've spoken to clients where their mortgage has gone from £1,200 a month to £2,000 a month. So it's very tricky times.
It is a lot, isn't it? When you sit there, some people could be paying an extra £5,000 to £8,000 a year, especially for young families. And like you said, you've got the heating, you've got all this other stuff that sort of gets thrown into it. And then you seeing with the affordability side of things and the stress testing, are you seeing a lot of deals either not fall flat, but people not able to get the LTV they want just because of that? Yeah,
definitely. On the ICR side, when you're looking at the rental income, I mean, the rental is starting to come up a little bit, so that is helping. But there are people that they think that they're going to be able to go in and get 75% on the buy-to-let, and by the time you put all of the figures in and you use the stress test, they're getting more towards 60%. And that is also a reason why people then opt for the bridging, because they seem to think that, oh, okay, well, if I get the property, do a little bit of work to it,
add some value,
put the rental up slightly because the property is better, then we might be able to look at the buy-to-let, which it's all hindsight. You can't really you're not going to know until you get to that point.
This is it. And I think people are starting to become a bit smarter about what they're purchasing, trying to look at this below market value. Obviously everyone's always looking for below market value property, but I think people are really focusing on that now, because you can sort of instantly add that value to it in a short space of time. And we keep talking about HMOs, holiday lets, again, because obviously the affordability and the rental yields on those are quite significant. You're seeing a lot more of that type of deal than previous years, HMOs, holiday lets.
Yeah, definitely. I mean, all the HMOs usually seem to fit the
ICR.
They
do quite well.
So those clients obviously tend to come back and actually take the deals because they can get what they want. And the same with holiday lets. You're obviously achieving a lot more rental income, so they tend to fit as well. And also a lot of lenders at the moment, where they're trying to kind of restrict their risk, some of them might have stepped away from doing HMOs or stepped away from offering holiday let finance. So a lot of it is coming into us, and a lot of the cases will fall into that category. Yeah, exactly. or multi-unit freehold blocks where you've got quite a lot of different ASTs and higher rental. So all of that stuff is still working.
I'll take it, obviously for people who don't fully understand, the underwriting process is the exact same for holiday lets. Is there any sort of different questions that you'll ask on a holiday let as opposed to a normal sort of property? What do you need to see?
So it's more so just the low, mid and high season rental income, because that's what we'll be working from. We would take the average of those three figures over 30 weeks occupancy, but even still that usually ends up being higher than what the property would achieve on an AST. And then just making sure that it's got obviously correct planning usage. It depends where the holiday let is. If it's on like a holiday let park, for instance, we might have to restrict the LTV because of the other lenders when it comes to exiting. They might not be able to find as many lenders that would want to do that.
Of course.
But if it's a property that it could be C3 residential, but you can also let it out as a holiday let, then that's obviously fine. We can go to 70% on those, in some scenarios 75, depending kind of on the area and how good the holiday let is, I guess, and the rental.
And then just sort of, one thing I was thinking about earlier is you sort of seeing, obviously down south at the moment, rental yields aren't that high. People are getting a bit more bang for their buck in the north of the country. Are you seeing from the brokers that provide business to MFS, you're seeing quite a lot of stuff, northern-based stuff on the buy-to-let market at the moment, some of the new builds there? And
we've got quite a few that were in Liverpool. I can't remember the name of the development, but there's quite a lot of stuff that's going on up north. We've had a few properties in Blackpool as well at the moment, quite a few portfolio landlords there. And And that's kind of key with that market, because where the value of the property is quite low, they are usually throwing a few properties in so that you can raise the loan amount that you need. But yeah, definitely seeing more stuff up there that's fitting. Whereas, like you said, the stuff that's down south where the yield isn't great, it's harder to get them to the LTVs that they want.
Yeah, you still seeing a lot of people wanting to refinance portfolios to release some equity to carry on buying, even despite what's going on in the market.
Yeah, definitely. I think people that kind of know the market and have been in these situations prior, maybe 2008, these interest rates at the moment aren't necessarily too scary to them, because they've been through it all before. So they're still, like
the seasoned investors.
Exactly. They've still got their eye on, like you said, below market value properties or auction properties and things that are coming up that they're going to see as investment. And if they've got low leverage properties in their portfolio, why not? If they know that it's going to make sense and they're going to benefit from it in the long run. Yeah, definitely still seeing that.
I think we're seeing quite as well. I've been speaking to quite a lot of people, a lot of portfolio landlords that I personally know. They're sort of looking at I call it the monopoly effect, where they're taking 3 of their smaller properties, selling them to purchase one larger property where they can obviously get a bit of higher rental yield, less cost because they're not paying to manage 3 properties. So again, I think it's sort of the way the market's going. People are adjusting. You know, we're quite resilient as an economy, and I think a lot of people are reviewing portfolios, adjusting them, and I think the seasoned investors will breeze through this quite easily. I think you'll see a lot of accidental landlords or people that have inherited a property that they put it onto the rental market or whatever it may be, that might decide they want to pull out for a little bit and move back in. But I mean, it's been absolutely amazing having you on today. Is there any advice that you sort of give to brokers that are coming into the market, what they should be looking for, and what you like to see on a deal when it comes through? Because obviously we don't have any application forms at MFS. But what sort of high level information do you normally like to see to have a quick snapshot at a deal and think, yeah, this is one for MFS?
Yeah, I think the main thing is transparency. If you come to us up front and you tell us all the moving parts and if there is any issues, we can usually
or anything in the background,
we can take a look at that and we can let you know up front and be as transparent to you as possible of what your rate's going to look like, how much we can lend. Whereas I think sometimes they leave a few things out because they think it might cause an issue, but then we find it out anyway. And then the client's the one that's there like, well, you told me we could do 75%, and then we're down at 60 or
for various different different reasons.
Transparency is absolutely key. If it's one that needs to go quickly, make sure that solicitors are already on board, knowing what they need to be doing. We're happy to instruct solicitors day one if it's a case that they think.
Same as we go to credit day one as well.
Yeah, exactly. But upfront, it's just obviously client information, nationality, residency, credit profile, if they've got anything in the background, what the loan is for, obviously, is the big one, how you intend to exit. And obviously property values, how much you're looking to achieve. If we've got that up front, we can get a quote straight out to you, refer it over to the credit committee and come back with DIP the same day. And a very quite small underwriting list, but it's in depth of what we will need. So on day one, you'll know exactly what we expect from you.
Yeah, amazing. And I think, transparency is key, more so than ever in this industry, because everyone's got issues, everyone's got problems. We know about it. We know how to deal with it.
We're specialists for a reason. We want to help.
It's the lastminute.com where you sort of getting ready to instruct legals. It's, oh, by the way.
And then it's changing. And if it's something that we have to revise the terms, it's
and then that takes time and again delays the process. But again, thank you so much for coming on today. It's been amazing having you.
Thank you.
Tell us about the underwriting process, and from that perspective, obviously we provide a lot of guides and various other things that people can download. If people want to find you, where can they find you?
Yeah, you can always go onto our website and there's buy-to-let calculators there, but you can also email us in. We've got an inbox which is brokers@mfsuk.com, and from there I'll be able to pick up your inquiries.
Amazing. And you can also find her on LinkedIn as well.
Yes.
I'd just like to say thank you for tuning in to Let's Talk Property with MFS today. Please don't forget to comment and subscribe, and don't miss out on any of our future episodes. If you want to learn more about market financial solutions and what we do, please do visit www.mfsuk.com.